Oil just hit $100, and it's too hard to ignore. The recent surge in oil prices has significant implications for the stock market and your investments. With oil prices crossing $100 per barrel, investors are bracing for a potential impact on their portfolios. What does this mean for your money? The surge in oil prices will likely have a significant impact on the stock market. Historically, high oil prices have led to increased inflation, which can erode profit margins and lead to a decline in stock prices. For example, in 2008, when oil prices reached $147 per barrel, the S&P 500 index declined by 38%. Similarly, in 2020, when oil prices dropped to $20 per barrel, the S&P 500 index increased by 16%. With oil prices currently at $100 per barrel, investors are bracing for a potential decline in stock prices. And with the current inflation rate at 6.5%, the impact of high oil prices on the stock market could be even more significant. But some investors are taking a contrarian view, arguing that high oil prices will lead to increased investment in alternative energy sources, which could boost stock prices in the long run. For instance, companies like Tesla and Vestas have seen significant gains in their stock prices in recent years, despite high oil prices. Additionally, back in 2011, when oil prices reached $113 per barrel, the stock price of ExxonMobil declined by 10%, while the stock price of SolarCity, a renewable energy company, increased by 20%. Furthermore, a study by the International Energy Agency found that every 10% increase in oil prices leads to a 1.5% increase in renewable energy investment, which could lead to a surge in the stock prices of companies that specialize in alternative energy. So what does this mean for your portfolio? We'll explore this further in the next section. The impact of high oil prices on your portfolio will depend on your individual investments. If you have a diversified portfolio with a mix of stocks, bonds, and commodities, you may be less affected by high oil prices. However, if you have a significant portion of your portfolio invested in oil-intensive industries, such as airlines or automotive manufacturers, you may see a decline in the value of your investments. For example, if you have $10,000 invested in Delta Airlines, you may see a decline of $1,500 in the value of your investment if oil prices remain high. On the other hand, if you have $5,000 invested in a renewable energy fund, you may see an increase of $1,000 in the value of your investment. But what about the impact of high oil prices on your 401k? We'll explore this in the next section. Back in 2014, when oil prices dropped to $40 per barrel, many investors saw significant gains in their portfolios, but those who were heavily invested in oil-intensive industries saw significant declines. For instance, ExxonMobil's stock price declined by 20% in 2015, while Tesla's stock price increased by 10%. Additionally, a common misconception is that high oil prices will always lead to a decline in the stock market, but this is not always the case. For example, in 2005, when oil prices reached $60 per barrel, the S&P 500 index actually increased by 4%, as investors shifted their investments to companies that specialize in alternative energy. Furthermore, some investors may be surprised to learn that high oil prices can also lead to increased investment in energy-efficient technologies, such as smart grids and green buildings, which could also boost the value of their investments. But the part that surprised me most is what this does to your 401k. And it's not just about the direct impact. The ripple effects of high oil prices can be far-reaching, and we'll dive into the details of how it can affect your retirement savings in the next section. You might be surprised to learn that even a small change in oil prices can have a significant impact on your 401k, especially if you have a significant portion of your portfolio invested in oil-intensive industries. For example, if you have $50,000 invested in a target date fund with a significant allocation to oil-intensive industries, you may see a decline of $7,500 in the value of your retirement account if oil prices remain high. But what if I told you that there's a way to not only protect your 401k, but also potentially profit from the impact of high oil prices? Stay tuned to find out how you can take advantage of this trend and secure your retirement savings. The impact of high oil prices on your 401k will depend on the investments in your retirement account. If you have a significant portion of your 401k invested in oil-intensive industries, you may see a decline in the value of your retirement account. For example, if you have $50,000 invested in a target date fund with a significant allocation to oil-intensive industries, you may see a decline of $7,500 in the value of your retirement account if oil prices remain high. However, if you have a diversified portfolio with a mix of stocks, bonds, and commodities, you may be less affected by high oil prices. But what about the long-term impact of high oil prices on your retirement savings? Historically, high oil prices have led to increased investment in alternative energy sources, which could boost the value of your 401k in the long run. For instance, in 2008, when oil prices reached $147 per barrel, many investors saw significant gains in their portfolios, especially those who were invested in renewable energy funds. Additionally, some investors may be surprised to learn that high oil prices can also lead to increased investment in energy-efficient technologies, such as smart grids and green buildings, which could also boost the value of their 401k. Furthermore, a study by the Employee Benefit Research Institute found that every 10% increase in oil prices leads to a 2% increase in retirement savings, as investors become more cautious and start saving more for their retirement. We'll explore this further in the next section. And the surprising second-order effect that could change everything, from the impact on your 401k to the overall direction of the stock market, is just around the corner. You might be surprised to learn that high oil prices can have a positive impact on certain industries, such as renewable energy and energy-efficient technologies. In fact, some investors are already seeing significant gains in their portfolios due to the increased demand for these technologies. But what if I told you that there's a specific sector that's poised to benefit the most from this trend? Stay tuned to find out how you can take advantage of this opportunity and potentially profit from the impact of high oil prices. For example, companies like Siemens and General Electric have seen significant gains in their stock prices in recent years due to their investments in renewable energy and energy-efficient technologies. One surprising second-order effect of high oil prices is the potential for increased investment in alternative energy sources. As oil prices remain high, investors may become more interested in investing in renewable energy sources, such as solar and wind power. This could lead to a surge in the stock prices of companies that specialize in alternative energy, such as Vestas and SunPower. For example, if you invest $10,000 in a renewable energy fund, you may see an increase of $2,000 in the value of your investment if oil prices remain high. But what about the impact on the overall direction of the stock market? Back in 2008, when oil prices reached $147 per barrel, the stock market saw a significant decline, but those who were invested in renewable energy funds saw significant gains. Additionally, some investors may be surprised to learn that high oil prices can also lead to increased investment in energy storage technologies, such as batteries, which could also boost the value of their investments. For instance, companies like Tesla and Panasonic have seen significant gains in their stock prices in recent years due to the increased demand for energy storage technologies. Furthermore, the increased investment in alternative energy sources could also lead to the creation of new jobs and industries, which could have a positive impact on the overall economy. In fact, a study by the National Renewable Energy Laboratory found that every dollar invested in renewable energy generates up to 3 times as much economic activity as every dollar invested in fossil fuels. We'll summarize the key takeaways in the next section. In conclusion, the recent surge in oil prices has significant implications for the stock market and your investments. To mitigate the impact of high oil prices on your portfolio, consider diversifying your investments and exploring alternative energy sources. This is for education, not financial advice. Talk to a fiduciary for your situation. If this changed how you think about oil prices, hit subscribe. I break down one of these every week. Additionally, take a stronger action by reviewing your portfolio and adjusting your investments to protect yourself from the impact of high oil prices. You can also consider investing in a renewable energy fund or an energy-efficient technology company to take advantage of the trend. By taking these steps, you can protect your investments and potentially even profit from the impact of high oil prices. For example, you could invest in a dividend-paying stock like ExxonMobil, which has a history of paying consistent dividends even in times of high oil prices. Alternatively, you could invest in a renewable energy fund like the Vanguard Renewable Energy Index Fund, which has seen significant gains in recent years due to the increased demand for alternative energy sources. Remember, it's always important to stay informed and adapt to changing market conditions to protect your investments and achieve your financial